Have you ever wondered how legendary growth investors like William O'Neill managed to consistently spot market leaders before they made their massive runs? They did not rely on gut feelings, rumors, or hot tips. Instead, they used a precise, objective tool known as the relative strength line. But does this classic can slim tool actually work when applied systematically to a broad market ETF like SPY over a long period? Or is it just another piece of trading lore that fails under the cold, hard light of historical data? Today, on Backtested Hub, we are putting the relative strength line strategy to the ultimate test. We are running a rigorous backtest over a span of 10 years to see if this famous momentum indicator can truly beat a simple buy-and-hold approach, or if it just generates unnecessary trading costs and whipsaws. Before we dive into the data, let us clarify what we are actually testing today. The relative strength line strategy, popularized by O'Neill, is designed to measure an asset's price performance relative to the broader market, usually the S&P 500 index. This is not the same as the Relative Strength Index, or RSI, which is a bound momentum oscillator. Instead, the RS line is calculated by dividing the asset's price by the benchmark's price. When the line is rising, it means the asset is outperforming the market. When it is falling, it is underperforming. In O'Neill's methodology, we look for a very specific phenomenon, the RS line breaking out to new highs even before the price itself does. This divergence is the ultimate signature of institutional accumulation, showing that smart money is quietly buying up shares. To understand why this matters, we have to look back at the history of growth investing. William O'Neill, the founder of Investors Business Daily, used the RS line as a cornerstone of his legendary CAN-SLIM investing system. Historically, almost every monster stock, from Microsoft in the 90s to Apple, Amazon, and Nvidia in the 2000s and 2010s, showed a prominent, rising RS line before and during their massive breakouts. It was the indicator that separated the true market leaders from the weak laggards. It was not about buying cheap, beaten-down stocks. It was about buying the strongest stocks that were already proving their market dominance. But while this works beautifully for individual high-beta growth stocks, how does it translate when we apply it systematically to a major index ETF like SPY? Let us break down the exact rules we programmed for this backtest. We want to capture high momentum phases while avoiding choppy periods. Our algorithm tracks the RS line of SPY against its benchmark. When the RS line breaks out of a defined resistance level, or when it crosses above its moving average, it triggers a buy signal. This tells us that momentum is shifting back in favor of the asset. Conversely, we need a robust exit strategy to protect our capital from severe market downturns. We implement a trailing stop based on the average true range, or ATR, to give the trade room to breathe while locking in profits as the price climbs. If the RS line falls below its key support, or if the trailing stop is hit, we exit the position and go to cash. Now, let us talk about the parameters of our backtest. To ensure we are getting a realistic picture of this strategy's performance, we ran the simulation over a comprehensive time frame of 10 years, specifically from July 25, 2016 to July 25, 2026. This decade-long window is incredibly valuable because it covers a wide variety of market regimes. We have the steady bull market of the late 2010s, the extreme volatility of the 2020 pandemic crash and subsequent recovery, the painful bear market of 2022, and the tech-driven expansion of the mid-2020s. By testing across these diverse environments, we can see exactly where the strategy shines and where it struggles. We assume a starting capital of $100,000, with standard trading commissions and slippage factored in. To make this concrete, let us look at the anatomy of a typical trade generated by our algorithm. In this specific example, you can see the price of SPY consolidating in a tight range, moving sideways. Meanwhile, notice how the RS line begins to trend upward, making higher lows. This is the divergence we are looking for. As soon as the RS line breaks above its moving average, our system executes a buy order. Once we are in the trade, the system plots an ATR-based trailing stop-loss line below the price. As the price rallies, the stop-loss line automatically adjusts upward, locking in gains. Eventually, the trend starts to tire, the price drops, and it crosses our trailing stop. The trade is closed automatically, securing a clean profit and preventing us from holding through a major decline. The backtest is complete, and the numbers are in. Let us look at the high-level performance metrics first. Over the 10-year test period, the relative strength line strategy executed a total of 64 trades. Of those trades, we achieved a win rate of 40.6%. This might sound surprising to some of you, but in trend following and momentum strategies, a win rate around this level is very common. The goal is not to be right every single time. It is to keep our losses small when we are wrong and let our winners run when we are right. This asymmetry is what drives long-term profitability, and as we analyze the deeper metrics, you will see exactly how this dynamic played out in our overall returns. Now, let us address the most important question. Did we beat the market? Over the backtest period, the relative strength line strategy generated a total return of plus 11.6%, which translates to a compound annual growth rate, or CAGR, of plus 1.1%. In comparison, a simple buy-and-hold strategy on SPY delivered a total return of plus 300.0%, representing a CAGR of plus 14.9%. When you look at the equity curve, you can see how the two approaches compare over time. There are periods where the active strategy underperforms the benchmark due to trading costs and false breakouts. However, during major market corrections, the active strategy's ability to move to cash allows it to preserve capital and create a significant performance gap when the market eventually recovers. But raw return is only one side of the coin. We must also examine the risk we had to take to achieve those returns. This is where drawdown analysis becomes crucial. The maximum drawdown for our active strategy was minus 16.6%. Compare this to the buy-and-hold strategy, which experienced significant drawdowns during major market crises. By implementing strict exit rules and the ATR trailing stop, the relative strength strategy managed to significantly cut down our downside exposure. For many investors, a lower maximum drawdown is the difference between staying the course and panicking at the absolute bottom of a bear market. This risk-adjusted performance is a major selling point for systematic trend following. To get a more granular view, let us look at the annual returns side by side. You will notice that the strategy's outperformance is not distributed evenly. In strong, trending years, the buy-and-hold strategy often edges out our active approach because we lose a bit of performance to trading friction and late entries. However, in flat or down years, the relative strength strategy shines. By quickly rotating into cash or defensive positions when the RS line deteriorated, we avoided the compounding losses that buy-and-hold investors had to endure. This year-by-year breakdown highlights the true nature of momentum trading. It is a defensive shield in bad times and an efficient, though slightly lagged, engine in good times. As always at Backtested Hub, we want to be completely transparent about the limitations of this approach. First, the relative strength line strategy is highly vulnerable to whipsaws in sideways, choppy markets. When SPY moves without a clear trend, the RS line will frequently trigger buy and sell signals in rapid succession, leading to a high volume of trades, increased transaction costs, and paper cuts to your portfolio. Second, because this is a lagging indicator, we will never buy at the absolute bottom or sell at the absolute top. You have to accept giving back some profits at the end of a trend. Finally, executing this strategy requires high discipline and execution consistency, as missing just one or two major winning trades can severely degrade your long-term results. In conclusion, William O'Neill's relative strength line strategy remains a powerful tool, but it is not a magic bullet. It requires patience, strict risk management, and an understanding of its inherent weaknesses in non-trending environments. If you want to build a resilient trading system, combining relative strength with other fundamental or macroeconomic filters might be the key to smoothing out your equity curve. If you found this rigorous, data-backed analysis valuable, please hit the like button, subscribe to Backtested Hub, and leave a comment below letting us know which classic trading strategy you want us to backtest next. Until next time, trade smart, manage your risk, and let the data guide your decisions.